At the annual Economic Policy Symposium hosted by the Federal Reserve Bank of Kansas City in Jackson Hole, Wyoming, Federal Reserve Chairman Jerome Powell said that the Fed would slow the economy to fight inflation and that it would cause some pain in the economy. It triggered a 3.4% stock market plunge that day, even though the Fed chairman's remarks were not a great surprise. The Fed has little choice but to tighten monetary policy, even if it causes a recession, to snuff out the burst of inflation that began in December 2020. From its experience in the late 1960s and 1970s, a period known as the Great Inflation, the Federal Reserve learned the hard way that inflation is not to be trifled with, and that ending inflation requires slowing the economy by raising lending rates, even if it causes a recession. The Great Inflation ended in 1982 only after restrictive Fed monetary policy imposed by then-Chairman Paul Volcker caused a 17-month recession, lasting from July 1981 through November 1982, the second-worst downturn in modern U.S. history. In his opening remarks at Jackson Hole, Jerome Powell said the Fed will be raising interest rates to slow economic growth, and that it will lead to layoffs and hurt households as well as businesses. These are the unfortunate costs of reducing inflation, the Fed chairman said, but a failure to restore price stability would mean far greater pain. However, the United States enters this recession after months of better-than-expected job creation. And inflation, as measured by the Personal Consumption Expenditure Deflator Index, declined for a second month in a row in July, indicating the worst of the high inflation cycle may have passed. September and October could be difficult for stocks as the Fed wages war on the post-pandemic inflation, as progress slowly, relentlessly grinds on.